All right, there you have it. That's S. Narain walking us through his market philosophy. A quick check-in as to what the index is up to. 25,400 holding out, but it's a flat day of trade. But it's anything but flat when we're looking at the rise of some of these new age tech stocks. From their 52-week lows, the likes of Zomato or PB Fintech or even Paytm have clocked in triple-digit returns. And we want to decode what really is fueling this rally and, more importantly, what the way ahead is for some of these companies. Sunil Subramaniam, market expert, joins in. And we've also got Ashi Anand, founder and CEO at IME Capital. Thank you so much for taking the time out. And Sunil, really the list of stocks is only getting quite extensive. Do you think that one of the reasons that we're seeing this sort of flavor returning to some of these stocks, because remember at the time of listing, it wasn't all rainbows and butterflies because there were lots of question marks regarding valuations, etc., is that now that there's a clear path to profitability?
Partly that, but partly also I think that there's so much liquidity in the market that what is very obvious has already been priced in. So I think now liquidity is chasing that which is going to deliver in the future and taking a punt. It's a risk. Not all of these bets will pay off, but because of the excess liquidity, sectors like an infra, the story of infra story has been there for so long that it's all in the price. So if somebody wants to make extra money out of it, right, it's looking difficult because those valuations are well priced in. In fact, some would say very rich. Whereas in these, the story of the future is coming through. So even if you say buy 5 of these and 1 or 2 of them pay off, it'll pay off on the risk reward framework. So I think it's a combination of those things, that there is excess liquidity also available, and liquidity always finds its levels, right? And that's what is playing off here. Second is the path to profitability you mentioned. I would say that these businesses take time to build core potential. And I think when they were launched, there was hype. And then you saw that the actual realities were not catching up. But now you're seeing that the world is changing, that the businesses that Zomato and these Nykas and these companies are actually getting ground level. A third small factor I would point out here is the composition of the investors who are buying. So you've seen this strong rise in demat accounts, and which is largely the youth. As you know, India is the youngest country, and you're getting this large number of youth coming who are willing to take this risk. So they are not traditional conservative investors. So the youth, when they have money, and the kind of SIP flows are also into small and mid cap. So fund managers are also having to look at these kind of names because that's where you search. So I think it's a risk reward play that's playing out right now, where the perceived reward is much higher than the risk. And with liquidity in hand, that's getting a chance to be acted out in the playing field.
Actually, put through Sunil. But Ashi, if I could get you in on the discussion. I mean, there's the likes of Zomato, Paytm, PB Fintech, Nykaa, Car Trade, and I could go on with the list. Considering you track this space very, very closely, and we've all known as the kind of, the question marks that have raised throughout their journey since listing. Now, at these current valuations, where is it that out of this list you still find value on the table?
So I think we've been very strong bulls on the space ever since the launch of our fund in February 2023. At a time when everyone was running away from this particular place, we went in and actually said that markets were underestimating not just growth, but also the path to profitability. And our assessment and our research very, very clearly shows that these companies are not only going to turn profitable, but they're actually going to turn highly profitable over the longer term. Now, when we're looking at valuations and after the very sharp run-ups that you've seen over the last year and a half, at current valuations, is this still kind of scope ahead? We actually very strongly believe so. And I think to understand valuations, you really need to look at what's happening in the underlying, what's happening in the underlying industries. Each of these companies are basically solving better ways for people to transact across industries. It's easier to buy insurance policy on a policy bazaar as compared to via an agent. It's easier to order food on Zomato vis-a-vis ordering phone in the restaurant. Every single new age digital platform is solving for a customer need. And you are seeing a tremendous amount of value migration away from traditional businesses towards new age platforms. And this is something that we believe is just the start. It is a multi-year. We believe that growth rate should actually continue very strongly over the coming decade. Now, while growth is probably well understood, the key point is profitability. And if you go deep into the cost structures of these companies, If you just look at something like an employee cost, you look at something like sales and marketing, over the longer term, there is no reason why these companies really need to spend more on these line items as compared to traditional businesses. Yet it's probably 4 to 5 times. So your traditional consumer companies would spend 5 to 7% on advertising promotion. A lot of new age companies are spending 40 to 50% because they're currently in hyper growth. Fast forward 7, 10 years down the line, these ratios can reduce significantly, and the amount of margin expansion that you're likely to see will actually surprise a lot of participants. So we run long-term models. We see, and I think very clearly, growth is not something that we see any issue with. We think it's still early days, but profitability is something which should surprise quite significantly. And then really the point, a Zomato at 30 billion. Can Zomato be 100 billion plus 7 to 10 years down the road? Policy Bazaar is currently trading about $10 billion. Is it worth a 40 billion 7 to 10 years down the road? Our numbers on very conservative projections without taking a lot of optionality that can be built on in these businesses is actually showing that quite clearly. So I think from our core thesis is that if you have companies that are growing at a very rapid pace, if they're going to be turning highly profitable, very strong free cash flows, this combination of strong growth and very healthy profitability is a very potent recipe for value creation. And when we launched the fund, we kind of believed one of the core thesis was that you saw huge value creation in US tech from 2010 to 2020. We expect listed digital platforms to do something very similar over the coming decade in India.
Taking the long-term view there, and the cost structure definitely leaves room for profitability to grow at a faster clip. But since we are talking about valuation, Sunil, do you think this Fed rate cut perhaps could provide that extra fillip, because growth stocks, DCF, SOTP, etc., tend to move on the positive side with the rates coming down? Do you think that could be a meaningful, factor to watch out for, or not really?
These are not rate sensitive stocks. So remember that. So the first impact of a Fed rate cut would be on rate sensitive such as banks and NBFCs. But that being said, I would say that though they are not rate sensitive, these are still highly leveraged companies from an operations perspective. So, there's a financial leverage and there's operating leverage. And just like, he was pointing out, these companies are spending heavily on sales and marketing and advertising and all of that. So the high operating leverage means that any additional growth actually comes free because you already incurred the cost for the next 4 to 5 years in the business. So when a Fed rate cut kind of a situation happens and the flow towards equities turns positive, right? Like I mentioned, traditional domestic old age businesses, those businesses are well known, and a 3 to 5 year projection of the profitability is already in the price. But these, because of the high operating leverage, you cannot just put a linear model and say that this grew at 8, will grow at 10, will then at 12. These are the 8, 10, 25, 50 kind of growth because of the operating leverage. And so when there is liquidity, so the Fed rate cut is going to bring more liquidities from FIIs into India. And FIIs are willing to take the risks on new age business because they understand this, because American consumer is been buying these. So definitely they would get a fillip from the rate cut, but from a different perspective, not just the rate sensitive part, but more the resultant increase in liquidity for equities, for emerging market equities, and within that for Indian new age business equity. So definitely they would say that there would be a good buying support in this sector from that. The other point, if I may just point out, you mentioned the word value when you spoke to me, spoke to him, and again now. I think these companies are not looked at from a value perspective at all in terms of their valuations. Why I'm saying this is value is what? Undiscovered value, right? You've not discovered it. In these cases here, because you're looking at the past P's and you're looking at their losses, or you're looking at their low profitability, and you're saying the valuations are high from P perspective, it's the PG ratio that matters, the growth. And the future growth is not linear, it's explosional and exponential. So from that point of view, I would say they will never look like value stocks. There will never be value from a traditional framework. But if you factor in that the high operating leverage plus their explosive business growth means that they could be multi-baggers in terms of kind of returns, then they do qualify for liquidity to come into them.
Right, and Ashi, I wanted to just get in your take. How have you read into the kind of meteoric rise that we've seen in some of these stocks? Has it come as a surprise to you? And what do you believe are going to be some of the key triggers? What's the way forward for these companies?
I think we've launched a fund, right? And we have a fund that invests exclusively in these kind of companies. We launched this in February 23 when everyone was running away from the space. At that point in time, what we were very certain about is that over a 7 to 10, 5 to 7, 10-year period, these companies are going to grow very rapidly and turn highly profitable. What we are very certain about and what we continue to be very certain about as of today is that the kind of value creation you're going to see over the longer term is going to be something which will actually surprise a lot of market participants, similar to what you saw in US tech over the last decade. But I think in terms of whether we were expecting the last year and a half to be so strong, our fund, for example, is up 100% in a year and a half. That is something that's actually surprised us. We weren't expecting markets to really gravitate towards these stocks as quickly as they have. A very important reason is that the path to profitability is something which has been a lot stronger than what people in the market were expecting. And I think the fact that they could turn profitable as quickly as they have, all companies across the board have actually achieved profitability timelines well ahead of what initial guidances were. That is actually something that led to this very strong rise. And the important point is we still believe that we're still in early days. I can give you just one simple example. Zomato executes some 75 crore orders every year. If you just introduce a 10 rupee platform fee and delivery fees have been introduced, there's not been a pushback. They've introduced small platform fees, there's not been a pushback. A 10 rupee platform fee accounts for 750 crores of incremental EBITDA. And this is just a single line item. If you go to each company, there are specific monetization levers that each of these companies have, specific areas where costs can actually be reduced outright, very strong operating leverage that can play through. So I think the very strong rise that you've seen this is greater market understanding of this kind of potential for growth and strong profitability going ahead.
Sunil, both of you, thank you so much for taking the time out and speaking with us today on what's the craze behind the new age tech stocks, and well, rightfully so. But let's now switch focus and let's talk about the frenzy in the IPO market. What's really going on there? What's been